Most people assume the global financial system is a neutral engine, something built to help economies grow, stabilize markets, and keep the world functioning smoothly. But what if that assumption is wrong? What if the system you rely on, your currency, your savings, the taxes you pay, and even the debt your country holds, was quietly engineered to serve a purpose very different from what you were taught? Today, we're pulling apart a mystery that has shaped a century of world power, a mystery that explains why the United States has maintained dominance far beyond its military, its culture, or its technology. Because hidden beneath the surface of every international payment, every trade agreement, and every government bond is an invisible architecture and undercover financial system that gives the US an advantage so enormous, so deeply baked into global economics, that most countries cannot escape it even when they try. This isn't conspiracy theory, it's not speculation. It's a structural, measurable, and historically documented design, one that economists and world leaders have argued about for decades. To understand how we got here, we have to step back nearly 100 years to a moment when the world was in ruins, currencies were collapsing, and global trade was suffocating. It begins in the ashes of World War II, when the world needed a new financial order. And into that vacuum stepped the United States, holding a unique combination of industrial power, untouched infrastructure, and nearly all of the world's gold reserves. In 1944, 44 nations met in a quiet New Hampshire resort called Bretton Woods to design the future of the global economy. What emerged from those meetings wasn't just a set of institutions like the IMF and World Bank. It was something far more consequential, a system that quietly placed the US dollar at the center of global trade. But the true twist, the mechanism that would later reshape entire nations, wouldn't reveal itself until decades later. Under the Bretton Woods Agreement, the US dollar became the only currency directly convertible to gold. Other currencies pegged themselves to the dollar. De Gaulle famously accused America of enjoying an exorbitant privilege, living beyond its means at the expense of the rest of the world. He demanded France's dollars be converted to gold, triggering a wave of similar requests. Faced with the global run on U.S. gold reserves, President Richard Nixon made a stunning move in 1971. He ended the dollar's convertibility to gold. Oh, it should have been a moment that ended U.S. monetary dominance, but this is where the story twists. Because instead of losing power, the United States found a way to expand it. A new system emerged, one not based on gold, but on something far more strategic: oil. In a series of secret negotiations with Saudi Arabia in the early 1970s, the U.S. struck an agreement that would change world history. This created what we now call the petrodollar system, and the effect was profound. Overnight, every country on earth needed dollars not for gold, but to purchase the lifeblood of the global economy. Whether you were Japan powering its factories, India fueling its transportation, or Europe heating its homes, you needed dollars. And that meant the US could print the currency the entire world depended on. Soon, nearly every major commodity from wheat to copper to steel shifted to dollar-based pricing. Countries began holding enormous dollar reserves. Central banks grew dependent on US Treasury bonds. International loans and debt markets became dollar-denominated. The US didn't just create a currency, it created a financial ecosystem. Here's the part that most people misunderstand. The US doesn't just benefit from everyone using the dollar, it requires them to use it. The global demand for dollars allows the US to borrow cheaply, run deficits for decades, and maintain military spending on a scale no country can match. In effect, other nations fund US power by purchasing the debt America continuously issues. This creates a strange paradox. The more the world grows, the more dollars it needs. And the more dollars it needs, the more the US must provide by going into debt. What looks like a weakness, massive US deficits, is actually part of the design. America's debt becomes everyone else's savings. And that means no major country can allow the dollar system to collapse without destabilizing its own economy. Nations have tried to push back. The European Union attempted to elevate the euro into a competing reserve currency. China launched efforts to internationalize the renminbi. Russia and Iran tried creating non-dollar oil trade. But despite political speeches and media headlines, the underlying numbers tell a harsher truth. Over 80% of global trade finance and more than 60% of global reserves still move through the dollar. Even attempts to escape the system inadvertently reinforce it. When countries dump dollars, others buy them. When nations sanction-proof their economies, They stockpile more U.S. treasuries as crisis insurance, and when geopolitical tensions rise, global investors run toward rather than away from the dollar because it is perceived as the ultimate safe haven. But perhaps the most shocking element of this entire system is how it weaponizes something invisible: trust. The US doesn't need to enforce dollar dominance with physical force. It only needs the world to believe that US markets are the safest, most liquid, and most reliable place to store wealth. That belief, reinforced through institutions, legal systems, and financial transparency, creates a gravitational pull no rival has replicated. During the 1997 Asian financial crisis, countries learned the hard way that not having enough dollars during a panic could destroy entire economies. So they began stockpiling enormous reserves, self-insurance that ironically increased global demand for dollars. China, Japan, South Korea, and others accumulated trillions, and once they had those dollars, they reinvested them back into U.S. assets, especially Treasury bonds. The 2008 financial crisis should have shattered trust in U.S. markets. Instead, the opposite happened. As the global banking system collapsed, investors rushed into U.S. treasuries, driving interest rates even lower and making U.S. borrowing even cheaper. The system didn't weaken, it hardened. America's financial problems became the world's problems, and the solution was always the same: buy more dollars. Today, the system has evolved into something even more complex: a digital financial empire that touches every corner of the economy. SWIFT payments run through U.S.-aligned institutions. Global banks rely on dollar liquidity lines from the Federal Reserve. And when COVID-19 froze the world economy in 2020, the Fed became the lender of last resort, not just for America, but for the planet, extending dollar swap lines to major central banks. In effect, the Federal Reserve became the global firefighter, supplying the one thing no one else could create: emergency dollars. This wasn't global charity, it was strategic necessity. If the world couldn't access dollars, global trade would seize up, financial markets would crash, and geopolitical instability would multiply. The undercover financial system had become so deeply woven into everything that even America's rivals needed the U.S. to stabilize the world. Yet beneath the surface, pressure is building. Countries like China, Brazil, and Russia openly criticize U.S. monetary dominance. Central banks are diversifying reserves. Gold purchases have surged to multi-decade highs. Digital currencies are emerging, and new trade blocs are experimenting with local currency agreements. But when we analyze the numbers, the actual transaction volumes, liquidity, convertibility, and debt markets, the alternatives remain too small, too controlled, or too unstable to replace the dollar. The irony is that every attempt to create a rival system has unintentionally revealed why the U.S. system is so powerful. China's capital controls prevent large-scale adoption. Europe's fragmented political structure weakens the euro's appeal. Commodity-backed systems lack flexibility, and blockchain-based currencies struggle with volatility and regulatory uncertainty. The U.S. didn't win because others didn't try. It won because the structure it built is still the most functional option available. But this story isn't just about the past. It's about repeating patterns, and they reveal something surprising. Every major crisis strengthens the very system that seems fragile. Every geopolitical conflict increases the world's reliance on U.S. markets, and every technological shift from credit cards to digital payments to global banking networks deepens the infrastructure of dollar dominance. For regular people, this system can feel distant. But its impact is everywhere: in the price of fuel, the cost of imports, the strength of local currencies, and the rise and fall of governments. When your country's currency weakens against the dollar, your savings lose value, your debt becomes harder to repay, and your purchasing power drops. When the U.S. raises interest rates, countries thousands of miles away suffer financial stress. This is why economists sometimes refer to the U.S. as the world's reluctant empire, not a traditional empire of territory, but an empire of money, where power flows through financial dependencies rather than military conquest. And like any empire, its stability depends on the belief that the center will hold. So the question is not whether the dollar system will end someday. Everything ends eventually. The question is how long its structural advantages will keep it dominant. History shows that reserve currencies decline slowly, not suddenly. And right now, none of the challengers offer the combination of liquidity, trust, legal infrastructure, and global acceptance required to replace the US system. As we look at modern data from reserve holdings to cross-border payments to treasury market depth, the pattern is unmistakable. Despite political tensions and global criticisms, the dollar's share in world trade remains overwhelmingly dominant. Even China, while publicly calling for reform, quietly increases its US bond holdings during periods of instability. That brings us to three clear takeaways. First, the global financial system is not neutral. It structurally favors the United States through mechanisms most people never see. Second, attempts to escape the dollar often reinforce its dominance because the alternatives lack scale, stability, and trust. Third, the US doesn't maintain power by force alone, it maintains it through a deeply embedded financial architecture that shapes the world's economic choices. But here's the warning: systems this powerful can create blind spots. The US must manage its financial power responsibly, because the world is becoming more sensitive to economic inequality, geopolitical imbalances, and hidden dependencies. If enough nations lose trust not in the dollar, but in the fairness of the system, the slow shift toward alternatives may speed up. For now, though, the undercover financial system that underpins US power remains practically untouchable. If you found this story eye-opening, share it with someone who still thinks global finance is just about money. Subscribe to the channel, stay curious, and remember, the systems that shape our world are often the ones we never see.